ELSS. ELSS fund. ELSS funds comes with the 3 years of lock-in period. Okay, be careful. 3 years. If you invest in lump sum, if you invest today, you will get your money after 3 years, like 36 months. After 36 months, you will get your money. But you do SIP, you will get your money after 6 years. That is the catch. You have to understand. Before you buy this stock, you know about how the locking period actually works. Okay, you don't think that you will get your money after 3 years. If you do SIP, you will get your money after 6 years. So before investing, you have to know about the lock-in period. I have explained this in later video, I mean end of this video. So before proceeding that, first understand where the liquidity LSS fund invest and what is the risk and how the interest you get. Okay, ELSS fund generally invest in equity. Okay, so it is very risky. You are investing in equity. If you invest 1.5 lakhs in one financial year, you will get a tax deduction of 1.5 lakhs. Okay, if you invest 50,000, you will get a 50,000 of tax deduction. Up to 1.5 lakhs is the max in one financial year. So take it as you wish. So most of the video you have seen, they compare with the ELSS with PPF, but PPF and ELSS are for both different thing. PPF invest their money in debt instrument. Okay, debt instrument are considered to be a secure instrument because they invest in government securities, which is way safer. And ELSS invest in equity, which is way higher, like way riskier. So equity ELSS gives you the higher return of 10 to 12%. It will go up to 15%. I think PPF will give you 8 to 9%. So don't fall with the interest rates. Okay, PPF comes with the 16 years of locking period. 15, I don't know, but 15 to 16 years of lock-in period. Okay, if you invest today, you will get your money after 15 years. Okay, so be careful about the PPF. And ELSS, it comes with a 3 years of lock-in period with the tax benefits. And if you redeem your money after 3 years in ELSS, you will get a tax. You will you have to pay 10% tax. So be careful about that. Okay, in PPF you have to pay zero tax. After 15 years, you will get your principal plus interest with a zero tax, and you will get a tax benefit entire year if you if you invest every year. Okay, that's the catch. And now we go with the login period. Okay, so ignore these changes because I have already recorded this video yesterday, but due to some error in the video, I am recording this again. Okay, locking period. Now let's talk about the locking period. On 1st Jan 2025, you invested 10,000 rupees as a SIP and it got locked for 36 months, which is approx 3 years, and you will get your money on 1st Jan 28. Right, okay. Now the next month, again you invested 10,000 rupees, but this time your money got locked for 3 years, which is 36 months, because whenever you do a SIP, you create a new locking period. Like you create a new account with a new locking period of 3 years. That's the catch in this SIP. So if you continuously invest for 3 years, you will get your entire money on 6th year. Like in 5th or 6th year, you will get your entire money. You can, okay, and you can withdraw only when the money we invested get mature after 3 years. Okay, we cannot withdraw before 3 years because it has locking period. Okay, that's a make sure. And there is another catch. There is a interest rate problem. Like, let's take an example for 1 year. This is the 1 year cap. Okay, so this money is invested for 12 months, entire 1 year, and this money is invested for 11 months, and same as 10, 9, 8, 7, and the last money is invested for only 1 year. Okay, so don't think that interest is my interest rate is low, that person invested in lump sum, they are getting the higher interest rate. That's the thing, because he invested in lump sum, so he invested the entire 1,20,000 for 12 years, 12 months. not for 1 month or 2 months, 3 months, okay, entirely. But there is a catch in lump sum also. You have to invest when the market is low. Okay, then only you will get a benefit. If the market is high and you invested your money, then you will get a loss. You will get a less interest because this is equity, not a debt instrument. It is a equity. Equity always fluctuate. And in a SIP, you invest when it's low, high, mid, anytime. So your interest will get balanced out, average. You will get an average money. Okay, just you will not get a loss, I think so. And same as it goes for 3 years. So at the end of third year, still you are doing a SIP. So your last payment would be on 1st December 2027, and that money you will get on 1st December 30, which is approx 5 years from your starting. You started your SIP from 2025, and you are getting your entire money on 2020, I mean 2030. That's the big difference. Like 5 years gap, you're getting your money. So okay, that's all I can explain. That's all. Now, and we get now comes to the investment. You made a approx 3,60,000 investment. If you invest 10,000 monthly, so you invested 3,60,000 for 3 years. That's your investment. Now we're going to calculate the interest. Okay, this interest is calculated based on the average. Most of the ELSS funds give you the interest from 8 to 15%. So I taken an average of 12% because most of the ELSS would give you 12% interest. Okay, this is, this is only for the information. Don't take it seriously. Okay. And this video is not given as a advice, a financial advice. This is only for the education purposes. I'm going just explaining you the concepts. Okay. Now, you let's assume that you invested your. Now, I'm going to give you the example of lump sum. I'm going to give you the example on lump sum because if I started giving you the example of SIP, so you will get like the formulas will get bigger and it will take much time. Okay, and I'm going to give you the lump sum. The same applies to SIP, but little much different because in this case, in SIP, you invested your money for this one is invested for 12, 11, 9, 10, and the last one is invested for 1 month. Okay, that's the difference. That's the difference. Okay, and in this, you invested entire money on first day, so your entire money is invested for 12 months for 1 year. Okay, okay, now start. So let's assume you invested your money on 2025 January 1st. Stately 1,20,000. You invested entirely in lump sum and you got an interest of 12%. Okay. At the end of the year, you will accumulate 1,4,4,409 14,400 rupees. At the end of the year is your interest, and total we calculate at the end of the year is 1,34,400. At the end of the first year, same amount. At the second year, now comes the second part. In 2027, again you invested 1,20,000 on the first Jan 2026. Okay, this money is also getting an interest rate of 12%. Now the interest rate are different because in this time this money also got as in lock-in period, and this money also invested for this money is now invested for 2 years. Okay, first year and the second year with this money. Okay, this money is invested for 1 year and this money is invested for 2 years. So we'll get a more interest. So same as I did, I added this and this money and I made a 12% interest. So you'll get on second year you will get 30,000 interest. Okay, it's far more difference, more than the double you get as an interest. And same, and at the end of in second year you will accumulate 1,50,000 by adding this 1,20,000. Like you invested and you got interest is equals to 1,50,000 you got in second year. At the end of the second year, in the end of the second year lock-in period, you will earn 2,84,000 total money. And same goes to 2027. Again repeat the concept again. So here we invested 1,20,000 on the first year 2027 with a 12% of the return, and you accumulated 48,000 because Now this money is invested for, like this money is invested for 3 years. This money is invested for 3 years, and this money is invested for only 1 year. So you accumulated 48,000, and this calculation is not based that you will get an exact amount. Okay, this calculation is made only to know how much interest you will get. Okay, this is the interest would be different, the concept will be different. Okay, this is just an overview. I'm just giving the overview that how you will get how the interests are calculated. Okay, so here we go. So at the end of the third year, you will accumulate 4,53,519 rupees. That's the total amount you will get at the end of the third year. If the you will, I mean, like your like your mutual fund get matured, you will get 4,53,000 rupees, which in that you will invested 3,60,000, and in total you will earn the interest of 93,000. Okay, you will got approx 1 lakh you got as an interest. That's the main thing in 3 years. That's the good thing. Okay, but this is not the amount you will get in your bank account. In that you will apply the taxes, because when you withdraw you have to pay the tax, 10% tax, as you know, the Indian government. Okay, in this we apply 10% tax, which is around 9,000 you have to pay as a tax for investing in ELSS, and effective interest would be 84,000, and your total you will get in your bank account is 4,44,000 for 3 years. That's you invested for 3 years, approx 3,60,000, and you got an interest of 84,000, which is approx you got 4,44,000 in your bank account. Okay, and yeah, you all know about the section 18C, 150,000 is a deduction. If you invest 1,50,000 in ASS fund, you will get a standard deduction of 150,000 stream. And yeah, if you invested 1 lakh or 50,000, 10,000, 20,000, so you will get accordingly. If you invested 1 lakh, you will get only 1 lakh deduction. If you got 50,000, you will get only 50,000 deduction. So let's assume that you now get. I am going to give you the example how the deduction would work. Like you under 10 lakh rupees per annum. Okay, in that you started a ELSS. You invested 1,50,000 in ELSS. So this 1.5 lakhs will be minus from 10 lakh. So your effective income would be 8 lakhs 50,000. In that there is a 50% of standard deduction. You all know, and other things you can apply, and you will pay the tax, and you will pay the tax on 8 lakhs, not on 10 lakhs, because you invested in ELSS. So in 10 lakhs, I think there is interest of 15%. In 8 lakhs, interest rate would be 10%, I think, because I have not checked out the new tax regime or old tax regime. Okay, so invest wisely, and this is not an advice video. It is for the educational purpose. This video has been made. So see you in the next video. So stay tuned. I'm going to bring you the new concepts. Okay. So bye bye.